the reason why retail investors are difficult to stock speculation. In fact, the problem to be faced is the asymmetry in the three important dimensions of investment. First, there is information asymmetry. The information received by the vast majority of retail investors is lagged and low level. Take performance as an example. Professional institutions often have a relatively accurate forecast for the performance of a listed company before the performance report is released. They collect big data on the market and build a more advanced information analysis system. Under such information analysis, institutional investors will still encounter the situation of stepping on thunder. So as the retail investors at the bottom of the information chain, how can they not be harvested? Including the hot spots in the market. Big funds are also the first time to respond, the first time to deploy, and the first time to participate. As for retail investors, most of them realize that the stock has already reached the daily limit, has risen continuously, and even realized it after the continuous daily limit. Some retail investors like to listen to news to buy stocks, and this so-called news is actually the bottom layer of the information chain. There is also only one final outcome, which is to act as a pick-up man. Stock investment is actually an information war. Those who get information in advance and get accurate information are more conducive to helping them make predictions about relevant investments, and there is a greater probability of making money. Some people believe in K-line technology. The reason why K-line technology is useful is that K-line itself treats all investors equally, and there is no information asymmetry, which solves the difficulty of investment decision making caused by poor information. However, the K-line technology cannot solve another problem, which is the asymmetry of funds. The second point we want to make is that funding is asymmetric. The second reason why retail investors make money is relatively low. The second reason is the asymmetry of funds. It's like if you go to a casino, you only have 10,000 yuan, and the big guy on the opposite side holds 10 million yuan. You must bet every time, but if you lose once, you will easily lose everything. Although the stock market is not so cruel, the gameplay is actually very similar, or it is even more unfriendly to retail investors. The main capital can use its own advantages to influence the rise and fall of the stock price, and find the optimal solution according to the market situation. For example, the selling pressure given by retail investors is particularly large. The main force can choose to suppress the trend, or choose a wave of retail investors to sweep the goods. If the retail investors follow the trend wildly, the main force can choose to take advantage of the trend to increase, or they can choose to take the opportunity to ship. The asymmetry of funds directly determines that most retail investors must lose money, because the main force can make reverse judgments based on the reactions of retail investors. It is as if the K-line is fair in terms of information and emotions, but the K-line itself is determined by large funds. It draws how it wants to, and retail investors can only predict through signals and follow the main force, but cannot decide the idea of the main capital. The main capital is not to say that it does not lose money. It will still lose money when the bear market comes, but the probability of losing money is much lower than that of retail investors. The third point is emotional asymmetry. The so-called asymmetry of emotions means that the emotions of retail investors are easily instigated by the market, and large funds are easy to incite market emotions. Simply put, the chasing and selling behaviors of retail investors are all under the control of the main funds. We all know that emotional fluctuations can easily lead to blind trading, but the ability of retail investors to control their emotions is very weak. For example, seeing that a stock is about to reach its daily limit, the main capital is to see whether retail investors will follow suit, and retail investors are wondering whether or not to chase. The main force is not emotional. Creating emotions and watching the market's reaction. Retail investors have their own emotions, and they are easily harvested by emotions in the end. When there is consistency in the emotions of retail investors, it is when the risk is greatest. If the emotions of retail investors are more opposite, half to half, it will be a nightmare for the main players, because they are overwhelmed. It's just that such cases are relatively rare, and there will be more in a bear market where transactions are deserted. Therefore, you will find that in the bear market, many of the main funds are mainly lying flat, because the emotions are very low, and the investors cannot be harvested by creating emotions. The three mountains of information, capital, and emotions. For ordinary retail investors, there is nothing to do, and naturally they will find it difficult to invest in stocks. Many people are curious. Where is the way out for retail investors, and how do smart retail investors make money? We will talk about this issue in the next issue. Please click like and subscribe. See you in the next issue.